I'm Tom Dalton. I'm a CPA and an accounting professor. Today I'd like to tell you a little bit about how partnerships work. According to the Uniform Partnership Act, a partnership means an association of two or more persons that carry on as co-owners a business for a profit. This includes what people sometimes call a syndicate, a group, a pool, a joint venture, or any other name you might give an unincorporated organization. Virtually any legal entity can be a partner, unlike S corporations, and it's the partners, the owners, who pay tax on the partnership profits, not the partnership itself. So the first question is, does a business rise to the level of a partnership? If it does, then it is subject to all the tax laws that govern partnerships, which can be pretty complicated. For an activity to rise to the level of a partnership, the activity must be an actual business, as opposed to just a passive investment. Merely sharing expenses is not a separate activity and would not normally be considered a partnership. A landmark case, Podell v. Commissioner, set the standard that a true partnership must have. 1. A contract to establish a business venture. 2. An agreement for joint control. 3. A contribution of money, property, or services. And 4. A sharing of profits. Here are some examples. Let's say that Bill and Adam purchase a single parcel of land as tenants in common. They don't develop the property, but intend to sell in a few years when the real estate market improves. This is probably not a partnership. Owning the land by itself does not rise to the level of an active business. If Adam and Bill decide to rent out the property and share the income and expenses, they meet the definition of a partnership, but they also will have an opportunity to elect out of being governed by the partnership tax rules, depending on the situation. Let's change those facts and assume that Adam and Bill subdivide the land and sell the lots. Now the activity is probably a partnership. Debbie and Carol are CPAs who share an office and a secretary. They each do work for their own separate clients and bill their clients separately. This is probably just a sharing of expenses and not a true partnership. Art and Ann, on the other hand, have the same arrangement, yet they pool their clients to create a profitable CPA firm. They share the profits of the firm. This is a true partnership. To avoid controversies that occurred many times in the past, the IRS issued the so-called check-the-box regulations, which allow taxpayers a limited amount of choice in selecting an entity for their business operations. Under the check-the-box regulations, entities incorporated under state law are generally treated as corporations. Non-incorporated entities with at least 2 members are partnerships by default, but can elect corporation status. Non-incorporated entities with only 1 member are called tax-nothings, in other words, a sole proprietorship, but can elect to be a corporation. LLCs, or limited liability companies, are commonly mistaken for corporations, but both LLCs and LLPs are partnerships subject to the same general rules as general and limited partnerships. In California, accounting firms, architectural firms, and attorneys form LLPs, limited liability partnerships, and other businesses form LLCs. All owners have limited liability. A partner in a partnership can have 3 different types of interests. A partner can have a profits interest, which is a percentage share of the partnership profits each year. A partner can have a loss interest, which is a percentage share of the partnership losses each year. A partner can also have a capital interest. A capital interest defines the amount of assets a partner would get if the partnership dissolved. This amount is measured as the fair market value of cash and property. These 3 types of interests are determined by agreement between the partners. This is normally documented in a written partnership agreement. In most cases, the IRS will respect this allocation, but there are some important exceptions that I will talk about in other videos. So, in general, there are three different types of partners. There are general partners, limited partners, and LLC owners. In most situations, they are treated the same, but there are some important differences. For example, general partners do not have limited liability. Limited partners cannot participate in the management of the partnership. If they do, they are no longer defined as limited partners. However, LLC owners have limited liability without the restriction. This is why you don't see many limited partnerships anymore. What you see now are limited liability companies, LLCs, in which all of the owners have limited liability and aren't restricted in their ability to participate in management. Business income allocated to a general partner usually is self-employment income. This means the general partner must pay self-employment tax on his or her share of income. Business income allocated to a limited partner is usually not self-employment income. Therefore, it does not generate self-employment tax. For LLC members, it depends. There is a three-part test that measures whether the LLC owner is acting more in the capacity of an active owner or a passive owner. The test determines whether the LLC owner's business income from the partnership is subject to self-employment tax or not. It gets even more complicated in trying to determine whether a partner's share of business income is subject to the passive loss rules. I'll talk about that in another video. This is a short overview of how partnerships work. In other videos, I'll talk more about the details and the special situations that arise in partnerships. If you have any questions, feel free to send me an email. If you like this video and would like to see more, feel free to hit the subscribe button.